Good evening, everyone. We are live from Chicago. Today is Thursday, March 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you're with us tonight. I kind of miss you guys because 4 times a year, it's 5 weeks between shows, and I get to that 4th week and go, I kind of wish I could go live, but we'll see. Maybe we'll do that sometime and surprise you. But here we are back at it again. No surprises here, lifetime highs. That's a surprise because this late in the first quarter, it's highly unusual. Now what's going to happen? That's the story we're talking about tonight. If you're new to the program, please subscribe to us on YouTube. Click the little bell so you get notified when we go live or when we upload a pre-recorded video, which we do from time to time. Also, subscribe on Facebook, subscribe on Twitter. Still got the little bird there, but it's actually X, and LinkedIn. That's actually our biggest audience, LinkedIn, but you can see us on all 3 platforms. I tweet every single day, sometimes twice a day. And these are the topics we cover over the evening. Sometimes we spend more time on others. Tonight, we're going to spend a lot of time on the monthly market review, talking about the Magnificent Seven. I'm going to handle some of your questions. We'll talk about that and our investment methodology. I want to spend some time on that more than normal, okay? So the monthly market review, it's just been a really good year to start. Now, the data that hit today that caused the market to go down was that retail sales are slowing. Okay, not a big deal. The S&P 500 closed today 0.7% off its lifetime high. All right, let's just put this in perspective. I know the news media likes to capitalize on drama, but there's not really much drama. Still, we pay attention to the data. So the inflation-adjusted retail number for February is slightly below average. But the 3-month data for real. So whenever you see me use the word real, that means inflation adjusted. It doesn't mean real as opposed to unreal, all right? But that's pretty weak, okay? So weak retail sales signals the possibility of a soft landing. Now, we want a soft landing. Remember, good news and bad news, it's hard to often know which is which when you're in a high interest rate environment. Not the case in a low interest rate environment, but in a high interest rate environment. Why? Because the Fed wants interest rates to drop. We want interest rates to drop. The Fed wants to keep its 2% mandate, and when the economy has heated up, they have to keep raising rates, which they know cast them in a bad light and doesn't help us as American citizens. So that's what's in play right now. This chart you guys see almost every show. Look at the right-hand side. We're right up here at lifetime highs. This is 100 years in the market. And there's just only one thing you can say. Over the long term, the market goes up. And secular bull markets last longer than secular bear markets. Secular bear markets are pretty painful, although they still have a positive yield, although barely. But I still maintain that we're about halfway through this secular bull market. Now, the Magnificent Seven, you guys see in the news all the time. Tesla, I just kicked off the, thanks to our graphic artist, kicked that off the line here because Tesla has been stinking up the Mag 7, Magnificent 7, and Apple has not been helping either, and frankly, neither has Google. In fact, it's pretty much the stupendous 2, which would be Meta and NVIDIA, and maybe Amazon, but definitely NVIDIA and Meta, all right? So, this is where we have. We got Apple, we've got Google, we've got Amazon, Facebook, NVIDIA, Tesla. It's just that the problem is that 2 of these stocks are really, really dragging it down, all right? However, the rest of the Magnificent Seven is doing well, and you can see what justifies people buying them. All right, their profits are higher, their strength of balance sheet is higher. They're just outdoing the S&P 500. All right, they're just outdoing it, and it's just plain to see, and that's why we have all of these stocks in our DS program, and we have a couple of them in CG and GI. But this extreme divergence in performance, and I'm looking at the screen and not at you guys, but this extreme performance here between NVIDIA and Meta is causing sort of chaos with the other five here. But how can we look at this as our advantage? And here's why. Because when you have this kind of disparity and the rest of the S&P 500 is able to make up the difference, that's actually good and healthy for the market. You don't want 7 stocks so far out in front that if any of them hiccups, there's a problem. Well, I've just mentioned that 2 of them definitely have a problem, meaning Apple, obviously, and Tesla. Google's not doing so hot, and we're still 0.5% away from the top of the market. All right, so that's a good thing. We're seeing, in other words, the strength of the market spread out. Okay, so the team at JP Morgan, and this is a good data point from them, basically said, look, I know everybody's reading that these valuations are a concern, et cetera, but they're actually relatively lower to the rest of the S&P 500 than the average over the past 5 years. You can see this divergence here. All right, and their quote is, look, we know about the concern, but what we see is that the group is currently trading less stretched meaning above all the other stocks in the S&P 500 than they were even a few years ago. All right, and the charts bear that out. All right, so the good news is, after looking at all this and going back 100 years, Goldman found that more often than not, the S&P still managed to rally over the 12 months after concentration peaked. So if we are at a place now where the concentration, that means of just a few stocks, in this case the Mag 7, because they're trillion-dollar companies, all right, if they are producing all the returns, that's a scary situation. Well, we're still, as I just said, 0.75% from the high in the S&P hit just 2 days ago, and we've got 2.5 of the 7 stinking. So this bodes pretty well. It's also important to note that these stocks are trading at elevated but not extreme valuations. Let's look at this. You guys have all been around long enough to remember the stock crash in 2000. All right, that was a 43 PE multiple. All right, that's the highest it's ever been on record. And of course, it was followed by a secular bear market. All right, now we hit 36 times earnings in 2021. We're now back to about 25 times earnings. So you can see we're way away from that 43. And yet, what's the key here? The S&P is still just a day or two away from lifetime highs. What that means is you can have a correction in price, and that's when the market goes down. You can also have a correction in time. And that's the ideal way to do it. So the market just kind of stutters and stays where it is, and then goes on to make new highs. And we have had almost a record number of new highs. I don't remember the last time. I have to get that for the April show. But the point is, we are not at extreme valuations, and that's why your accounts are still fully invested. The data further shows 1 year after each all-time high, stocks were up an average of 15.3, positive 12 out of 13 years. And if you take it to a 2-year delivery, okay, the average climbed to 23%, even though it dropped 1. It's only 11 out of 13. Guys, any way you look at it, when we have hit new highs, the momentum that gets behind that, the cash that's been on the sideline, and there are plenty of money managers that are just perma-bears, meaning permanently bearish. But if they don't want to lose their clients, they have to go in and buy. All right, and that's why when you see lifetime highs like we've seen, for 12 out of 13 years after a 1-year period and 11 out of 13 after a 2-year period, the market's substantially higher, 15% and 23%. I'm going to bet on those odds when I'm making trades for you guys. So here's why I think the returns can continue. Market continues to hit all-time highs, even here in March. I mean, sure, we had a sell-off today because of it's Sales, let's get this back. I lost my train of thought here. So we had CPI a little bit hot on Monday. We had PPI a little hot today. And we had retail sales disappoint. I got to try to remember all this, guys, and sometimes I slip. But the point is that even with all of that, we're still, as I said, just 3/4 of a point high. So off the high. Inflation remains moderate. That's what's important. We're going to talk about inflation a lot tonight because it's on a lot of your minds. I know. I see the questions that come in. All right. They suggest that the Fed may be closer to easing. Well, when I wrote that, that was before today's news report. I guess I could have updated that. I'm still saying June. It's definitely not this month. I don't think it's going to be May either. All right. The likelihood of a rate cut in June is high, maybe medium high right now after about 9 hours ago. All right. And I think that prolonged easing is going to happen, which will be bullish, of course. But it just so happens that there is, have you guys heard this? There's an election in November. Jay Powell, if Trump wins, will not keep his job. Jay Powell, if Biden wins, will likely keep his job. Do you think that he's going to be able to be at arm's length when he and his Federal Open Market Committee are meeting and trying to decide whether we should have rate cuts? Sure he is. All right. Final slide. We have finished the quarter. We only 6 stocks left to report. 494 have reported. Okay. So, consumer staples beating the S&P, technology, the most important sector at 89%. That's really the driver right there. That is beating the stocks here. So that's what we want to see. 89% are above the forecast. 6% are below the forecast. All right. U.S. policy. So I'm going to have to say, I had a comment here. It's all right. I just now saw this. Respond in the chat box. Am I overloading here? Am I either speaking too loud or maybe I need to look at my input here and see if there's something. I'm going to pause just for a second. Type in the chat, guys, I'll back up from the mic. How about that? And it could be I'm just wound up tonight. Sorry. But I will turn down the microphone just a little bit. How about that? Okay. So fair warning, guys, U.S. policy. This is going to be a controversial section for some of you that I guess would be more on the blue state variety, but I have to call it like I see it. I'm not going to make an assessment on whether liberal or conservative policies are good for every part of the economy, but all I'm responsible to do in this segment is talk about your portfolios. I can't offer social commentary, equality. I just can't do any of that. All right. So when it comes to your portfolio and how it's affected, that's what I have to do. Okay. So politics bleeds into policy. And of course that has personal impact. And that's why, it's so important. It just is. So, thanks, Doc. So, and thank you, Larry. Good to see you, Larry. Okay, so I backed off. Maybe I was just too wound up, guys. Okay. All right. I'm just glad to be back. It's been 5 weeks. Here they are. The presumptive nominees, no longer presumptive. They are the nominees. And it will be the longest election cycle in American history because they both won their preliminaries before, I guess in Trump's case, because he's not in office, normally it would take till either May or June, even sometimes July, when it was Clinton, Obama. That's how long it took. But it's already done. So now you're just going to see the mudslinging begin, a multi-billion-dollar campaign. All right. So here's just a word of wisdom that I like this, and I thought I'd put it in here. So all governments suffer a recurring problem. Power attracts pathological personalities. It's not that power corrupts, but that it is magnetic to corruptible participants. I'm not going to make a comment on if we have anyone like that, either seeking office on the left or seeking office on the right, but I would say that you can see that at the state, local, and definitely federal levels in Congress and in the executive branch too. So government outlays. All right, I'm not going to give you the time frame until the last line. You'll see this. Government outlays were expected to more than double the total receipts. So $567 billion in spending, $271 billion in receipts. That's a $296 billion deficit. Well, you can see that annualized number. And you were thinking this was an annual report. This is a monthly report. And that is because this White House is literally flogging the nation's purse, pushing it to exhaustion. Again, I'm just telling you the math. If this were Trump in office and he was doing it, I'd be calling him out too. And I did when I was doing the show and he was still in office. So with 9 months to go, every possible way to spend money will probably be employed. I hope that's not the case, but it probably will be. It is very difficult for any president to get into office and not want to spend money because no one wants to be austere because they think it will hurt their chances to be reelected and in their polls. But without a change at the highest level, it means the natural rules of prudence and assumed rules of physical restraint are banished. President Biden's proposed 2025 budget is for $7.3 trillion in spending. The previous high under Trump was 4.7. So in other words, Trump was higher than Biden's first 2 years. But most Americans just don't understand, but I know you do because you're watching this program. The corrupt media will not report these levels of spending. Last year, Americans sent $4.4 trillion in taxes to Washington. Now, think about it. How long have we had a federal income tax? Just a little over a century. That's right. All during the 1800s, there was none. Taxes were paid locally. They were paid to states, not the federal government. Why? Because the federal government was not called on to do that much to support the country, just support the borders. A lot of people still want that, all right? But that's not what the people in office, and again, Republicans are spending big money too. They want a big federal government, all right? President Biden is responsible for $6 trillion of this $34 trillion debt in just 3 years. He's the biggest spending president in history. Do I think that if President Trump, former President Trump, were to be back in office, that he would also spend to that level? He might. He might. He's a one-term president. Remember, he doesn't worry about being reelected. So the problem is spending at all levels here. And it's not just at the federal level. You have people that are residents of many, many states. And they're just fed up with it. They're leaving. They're going to Florida. Now, what's interesting to me is the number 4 state's Georgia, a southern state, Texas. I'm not surprised to see Pennsylvania and Illinois, but Tennessee, Alabama. Okay, Ron DeSantis, excuse me, may not have been a great presidential candidate, but he certainly knows how to run that state. That's why he was reelected by 20 percentage points. And a lot of people are headed there. Corporations are headed there because they don't like the way the state governments are running and the deficits they're running. So this is just a chronic problem across America. So do we have a debt problem? And I'm going to take a break after this and get a water here to get my throat. So this was actually data from 34 years ago. 34 years ago, and I want to get an updated version of this by the end of the year. If somebody can find it, or I'll go out and search for it. But this was done by Bloomberg Graphics, and they were certainly around 34 years ago. But so what is a billion seconds? 32 years ago, it was 1959. A billion minutes ago, Jesus was alive. A billion hours ago, our ancestors were living in the Stone Age. A billion days ago, no one walked on 2 feet on the earth. But $1 billion ago was only 8 hours and 20 minutes. Now, right now, it's about 8 minutes. All right, based on those deficit numbers that I just gave you. $1 billion spent every 8 minutes. All right, we can't continue this. And I don't know if it's a concern for you, but it definitely is for me. I'm going to talk about the Fed in just for a minute. Let me pause, get a drink here. It was a bit on the high side, but turned down the volume. Good. Guys, thanks. I'm sorry to be blasting you out. See, that's what happens when I get excited, when I get my audience back. Any other questions? Curious how term limits would affect the stock market. it seems what we need this country, but also curious about on the flip side. So nobody's going to vote for term limits. The problem is that you have to get the people in Congress are the ones that make the laws. And why would they do that? Because if they really had the country's best interest in mind, that's what they would do. Then you have to judge for yourself if they honestly do have the country's best interest in mind. And I don't think so. This will be the first time that I can recall, correct me if I'm wrong, anybody, where we have two presidential candidates that cannot be reelected. First time. So they're both lame ducks, no matter what happens. Okay? All right. Back to the Fed. So Powell says we're not far from the confidence needed to cut rates. Well, I think the market changed its opinion today, again, because we had some really hot data from producer price index, and we had consumer price index on Monday, which was also hot, and retail sales were kind of weak. So we're just on this very difficult tightrope, and I got to hand it to Powell. It's tough, and Powell and all the members of the Federal Open Market Committee, they just want to sort of under the radar sneak this inflation number down to 2% and then look around and go, never mind. We just got it back here. Just carry on. Keep doing what you're doing. Don't worry about anything. It's going to be fine. It's a tough hat trick. If he can get to 2%, then they'll start with modest rate cuts, unless they start with aggressive rate cuts for the aforementioned political incentives that I mentioned to you earlier. Okay. So back-to-back CPI hot. All right. The path to reach 2% is tough. They know they need to do it. Causes of inflation, have evolved since the pandemic. Obviously the pandemic we're still kind of getting over. It's 4 years now. But durable goods experiencing deflation is a good thing, but the rate hikes still seem to be off the table for the short time, but they think they will be back on the table by June. But here's the thing, quit trying to guess what the Fed's going to do. Investors are almost always wrong. So this is a funny looking chart. Look at 2010 down there. So the Fed just left those rates low. Those blue lines are what the expectation is. That's what the media is saying. That's why I tell you guys, quit watching the media. Quit listening to the media. They don't know anything. And they kept saying, oh, it's going to rise. Oh, it's going to rise. Oh, it's going to rise. And then they finally give up the blue lines from 2012 to 2015. And then, oh, they're going to rise. They're just guessing. I mean, here's the takeaway. The Fed is the Fed, and everyone else is just guessing. All right. So the employment scenario, the reason we do our show on the second Thursday of the month, we used to do it on the third, but we backed it up to the second because it just made sense to talk about the employment report, which came out the previous Friday. So the actual first indication of payroll is from ADP. So they're payroll processors. You guys know that. And they come out on a Wednesday, and then on Friday, which was last Friday, we get that data. And the data was, we added 275,000 jobs in February, but the unemployment rate rose. It seems kind of strange, right? But why? Because people started coming back into the marketplace. As strange as it seems, the labor force participation rate has not really done much since COVID because some people just decided to stay home. And if you're in an environment where the government will let you just get by and just get on a minimum amount of sustenance support from the government, then you can do that. But why does this matter? Job creation's robust. More Americans were looking for work, and the labor market has stayed surprisingly strong. What that does mean is the Fed is going, okay, with this being strong, that means it's a strong economy. We can't let things heat up, so we may not raise rates, but we certainly are not going to drop them. So economists expected about 200,000 in the report. The previous 2 months, that would be December and January, cooled slightly. So there's always three issuances. So when we had the report for February, there's going to be a February update in April. There's going to be a February 2nd update in May, and then it starts all over again in June. But there are always three reports because they're trying to fine-tune that data. And sometimes when they go back and revise it, that affects what happens on that first Friday of the month and how people trade it. Okay? So I think it was basically a neutral reading. I'm not using it as a data point to make decisions for buy and sell. I think the Fed's job is basically bringing things down on a slow basis, and they're doing it while minding inflation. You see these 5 bars here, 1, 2, 3, 4, 5. Okay, so inflation accelerates for the 4th consecutive month, but look at the chart on the left. Look at the scale is what I'm trying to say. That's percentage. So 1/10 of a percent, 1/4 of a tenth of a percent, 1/2 a percent. It's just not that much when you look at the scale. Cleveland versus Harrison. I see you, Dr. J. I think Cleveland versus Harrison, that was the last time. Oh, of course, Grover Cleveland in his 2nd term. Sorry, guys, to get off the topic here. I knew that Jay would find that. Yeah. William Henry Harrison and Grover Cleveland. How about that? Okay, so we are seeing it increase. The CPI, Consumer Price Index, still above the Fed's 2% target. But if the Fed will just be diligent, let the economy cool on its own without causing a recession, that's what market participants are wanting to see. They don't want to have to go into defensive mode because they don't make as much money in defensive mode. The big wirehouses that have billions and billions, trillions of dollars, literally. So they're encouraging the Fed, just let it come down slowly. Do not put us into a recession, which nobody wants, not the Fed either, okay? Now the sentiment is that inflation's actually going back up. See that tiny little tick there? But to me, that's, again, not enough to trade on. What I'm seeing is inflation's coming down. What's the preponderant direction of that? Down. And that's a good thing. I don't have to see that last percentage to go down to 2 to keep fully invested. And it's a good thing because it's worked out well for you guys, which you'll see when we get to the performance. We've been fully invested this whole time. Ever since October 4th, I think it was. The low of that downturn or mini correction. It wasn't even a cyclical bear market. It was just a correction. So economic indicators, everything I've shown you so far, usually, especially the first section, is how we made decisions, what we were making decisions on, the Mag 7, earnings reports, etc. And then interest rates, unemployment, if there was anything dramatic. There was not anything dramatic. But these economic indicators are things that I'm looking at, not even for the 2nd quarter, which begins in a couple weeks, but 3rd and 4th quarter of this year. What am I seeing that could influence it? So household wealth has jumped, and this is because portfolios have jumped. And you can see it's pretty significant from 2020. 2020, it actually took a downturn, came back up, but this gap between real net worth and household net worth, pretty strong. So when people are confident and they see their own net worth increasing, they want to spend. They feel more comfortable spending. When the consumer is spending, that's what drives our 67% of GDP is Americans spending money. All right, that's a good thing. So productivity has actually outstripped wage growth. Now, again, I should be concerned about the workers. I am. I want them to be properly paid. It means that they're working and producing more widgets and not getting paid for it. But it also means that companies are generating higher profits, and we like that because that's what affects you in a positive way as an investor. So I don't know if you guys, who has an electric car out there, if it's working well for you, but I've been following this story of a Swedish company, I believe. Maybe it's not Swedish, maybe it's Japanese, but someone who's got this battery technology that actually is being installed in 100 miles of roadway in Michigan. Right there, of course, in near Motor City. And right now it costs $761 million, I think is the number I read, to build a mile of interstate. Okay? It would be about $1 billion or another 25% to insert these charging pods, which are then powered on a grid, and they come on only when vehicles are driving over them. It's pretty cool technology. But when you see that happen, then I can see that that's going to be, obviously that would be a boon for Tesla and any other electric car company. But I'm watching to see if this looks like it's going to be funded at the federal level to try to get a greater acceptance for electric vehicles. I'm not saying that's what we should do, but that's what I'm watching because that's where investments can happen and in those support services. You probably heard during the gold rush, A lot of people that sought to find gold didn't find it, but the people selling them shovels and picks and satchels made a ton of money. So the people supplying that for the roads would as well. Good spending continues to outpace services. So people are staying home. They're fixing up their homes. They're not going out quite as much. The trend continues to be durable goods. They're buying stuff for their home: washers, dryers, refrigerators, microwaves, toaster ovens, and bedrooms, suites, and whatever else. And saying, you know what, I'm going to spend the money there and not go out. That's a trend, still being good for the consumer to spend. But here's the big concern in this economic indicator. Americans now pay as much on interest on other debt as they pay on mortgages. I mean, think about that. If you're paying $1,000 a month in interest and $500 in a mortgage and $500 on credit cards, now maybe for you guys watching this show that seems incomprehensible. I think it probably would be for most of you, but many Americans, all right, look at the non-mortgage debt in the black line and the orange sort of graph there behind it, and now they're equal. Okay, it is now equal $600 billion seasonally adjusted annual rate of interest payments. This is not sustainable, and it will affect consumer spending, which means it affects our investments. I will be watching it, I assure you. Have I missed any questions? March is half over. How does it fly by? Larry, you're correct. It does. I don't think I've missed anything else. I guess the volume's still okay, guys. I've calmed down here, so we're not blasting you. So in AI, I've had some gee whiz segments, if you will, where we talk about companies that are coming out with all kinds of great ideas and models that no longer, the dresses that are on these fake women, they can go on and buy clothes and whatever and not have to actually employ models because they just generate them with AI. But today I just want to talk about the actual employment part of it. So look at this disparity between IT jobs and AI jobs. So sometime in the middle of last year, AI jobs took over as a bigger portion of IT jobs than just the IT jobs themselves. That says to me, this is growing. And yes, it's come back a little bit, in the fourth quarter there, IT jobs catch up. But in general, that's a trend that I think is going to continue. So why is this? They're up 42%. Pardon me, I don't know what's going on in my throat tonight. Compared with December 22, that was the nadir, word of the day, nadir of the AI job listing market. All right. And part of this is because ChatGPT, believe it or not, just came out in December of 2022. I mean, that's how short a time it's been with us. And look at all the other different GPT engines or AI engines that have come out, pods, if you will, to compete with that. But all of this is just in the last year or so, guys. It's just astounding, right? So newly listed jobs, AI has been sort of flat over a 5-year period, but pretty steady. Whereas IT jobs come and go. I mean, you see just yesterday, Oracle announced laying off, I think, 3,000. I mean, Apple's laying off a bunch because they ground their car project to a stop 10 days ago. All right, so AI in the past 16 months, 15 months, I guess it is, growing 15.7%, data analysts down, software engineers down. This is a interesting data point. I have to dig into this, and I have clients who are in IT. Maybe I should be conferring with you. This seems contradictory to me, but I'm just reporting it. Indeed is a pretty reliable employment service where people look for jobs, etc. So AI is employing a lot of Americans. AI is employing a lot of technical people across the world. And so that's why I just wanted to focus this first section of this segment on the employment part. So people still ask me, how can these AI programs, bots, answer almost any kind of question? Well, they're powerful computer systems using this generative AI. Now, I've talked about that in previous shows. I'm not going to spend much time on it here. But basically, they're being trained to go out and hunt for information. Now, they don't get in their car and go to the local library. It's all coming from the internet or private databases. So this is an area in healthcare. So say you are, Johns Hopkins and you have an enormous database that's not on the internet, and you're trying to generate an AI bot just for your doctors, all right, or Mayo Clinic in Minnesota, Cleveland Clinic, etc. So basically, imagine if you could pretty much read everything on the internet or one of these intranets, all right, and have the ability to remember it and spit it back. This is what AI does, all right? Material coming from millions and millions of websites, digitized books, magazines, scientific papers, etc. So what are the implications? I don't know whether to be uneasy, frightened, or welcoming. Well, actually, maybe all three. On the upside, there's just a ton of information. It's more concise than just searching on the internet, more to the point than a jumble of links you get when you do a web search. You ever had to do a search for something and it comes back with, oh, there's only 189,000 links you need to review. Okay? The downside, AI does not, I say don't, but AIs, that's plural, don't think the way humans do. This thing is not intelligent. It has no understanding of what it's saying, and more important to me, nor does it care. Okay, it doesn't have the ability to self-correct. It just doesn't. Customized by a particular template. Can you expand on that, Andre? I want to reply to that. So, and you must be talking about AR search bots, okay? All right, and when I see your response, I'll reply. I'm going to go ahead and go forward. So the investment methodology, we close, well, not quite close, because we have a question segment tonight. This will be new. I gotta find my sheet here. But for now, investment methodology, you guys know our programs. Spec Op, I never talk about this program, but someone once said, between the last show and this one, so what is this $250,000 minimum, really? And what's the deal with that? So CG, almost every one of our clients has a CG account. Almost all have a GI account. DS is something we just rolled out the last few months. And the reason that we did this is because of people wanting to have a high volatile but high risk program without the stops, without the money management, because they don't want to be stopped out. We're going to actually address that in the segment tonight, okay? And then ETF for smaller accounts. I had someone bring in a child account. It was like $28,000 or something. I said, yeah, it can go into ETFs because you can't trade 30 stocks like we have in CG in a $30,000 account. So I just got this today. One of our viewers sent this to me. I love it. Life can only be understood backwards, but it must be lived forwards. And I extrapolated from that. Investing and trading can only be understood backwards, but buying and selling must be lived forwards. That's pretty profound. I bet Savorn Kierkegaard did not know that was going to be used 200 years later. So this is, in many ways, our most successful program this year. This is growth and income, what we call GI. You can see the blue line. And again, all these are the benchmark accounts. These are my own personal accounts. We have Alice has accounts. We have trust accounts. But my 4 accounts are what we use for the benchmarks. And not a single day this year has GI lagged the market. And GI is only 60% in stocks, 25% in bonds, 15% in a special asset that trades commodities. That's right, in a mutual fund, commodities, currencies, foreign stocks. It's an interesting play. But I want you to look at the Sharpe ratio. So Sharpe ratio, you want to be higher. 5.57, pretty high. Standard deviation, 0.49, you want that to be low. Okay, let's go on to CG. So, yeah, CG's done pretty well this year. I don't know if it's going to turn around like a 2020 year when we were up 63%. I am definitely not going to predict that. But it's on its way to doing well. Now, notice that its Sharpe ratio is lower. Let's go back, 557. And, all right, 480. And its standard deviation is 0.85, 0.49. Okay, so you would say, well, that's not as good as GI. Okay, but the return's higher. So the only thing that can mean is you just have to take more risk. Look at the max drawdown. See max drawdown there? 1.73%, max drawdown 2.79%, a bigger drawdown. All right, and let me check Andre here. For example, we saw a presentation by Thomson Reuters, okay, where it feeds in a custom legal document, like in order to better help. Yeah, I like that. And I like Thomson Reuters too. So for example, right, got it. Appreciate your questions, guys. And I'm going to handle more of these at the end too, but you can always just keep typing when I'm chatting, and when I see it here, I'll go grab them. So you guys haven't seen this for several months, but we have a matrix. So when Matt and I are making decisions, we're tracking what are the biggest profits we're making, what are the biggest losers, what's our ratio. I've highlighted that for you, 2.7 to 1. We'd like to see that at 3 to 1. So every winner is 3 times the size of a loser. And that's because most of the trades are losing trades. And you've heard me say this, I have to go back to previous episodes. But 1 out of 3 trades, literally 33.87, is a winner because we use stops and we cut losses. We are not going to hold a stock forever and just sit there and get whacked. Now, we will do that in DS, and I'll talk to you about that in a second. But for CG and GI, which holds the preponderance of our clients' retirement assets, not their speculative assets, but their retirement assets, we cannot be that aggressive. All right, biggest profit, 88%, biggest loss, 35%. Clearly, the math favors us here. And if we just do this time after time after time for decades, it's going to be a successful program. All right. It's not going to have killer response during a roaring bull market because we're hedged. And I'll get to that later in this section. I found a really good set of charts here that I haven't shown you before, and I'm going to do that tonight. So DS, this is a different program for us. Look at the Sharpe ratio, 186. Okay, so obviously that's not as good as 480 or 557. So why would we trade this? And a standard deviation of 1.6. All right, worse. Well, because of the potential of the upside in this program. This is the 6.5-year return. And those are audited actual numbers straight from an Interactive Brokers account. Now, look at the Sharpe ratio. Look at the standard deviation for 6.5 years. The maximum drawdown for 1 month, worst return was over 20% for a month. What it doesn't say is the next month was just as bad almost. But why would we offer this? Okay, so a few clients started trading this with me, and I thought there's no way I'm ever going to offer this. And yet, last year, with the volatility in 2023 in the autumn, we were stopped out of quite a few positions in CG, and then the market made a jackknife and went higher, and we got back in and finished the year pretty well, but we did not make what the S&P did. And many clients were saying, look, I don't want to take those stops. I want to just stay in. I don't want to try to trade and time the market. Okay, so we have a program for you now to do that. But as it said, if you read the fine print on the page that showed all our programs, we have to have an interview, you and I, because no single client, I have the largest percentage of any client in DS, and that's 12%. If someone did say, I want to put about 30% in there, it's like, I'm not going to do that. I refuse. You can. I'm your client. Yeah, I can. All right. Now, if you want to show me another $2 million in net worth where the ratio stays okay, but when you have a combined 62% drawdown in 2022, I don't want your lawyer calling me. Where am I going with this? Risk and reward. Okay. We try to balance that carefully for you. We have a program to suit pretty much any risk and reward that you might have. This is where the nitrogen report comes in. You guys are aware of that. Those of you that have been with me for a while know that nitrogen was first called Riskalyze, okay? But they've morphed into this name called nitrogen. New clients, that's all they know is nitrogen, okay? So this is a return that you can see, but the problem is, let me go back here, can you live through those drawdowns? If it's a small enough account, if it's a speculative account, if you have a terrific return, and I've had a client do this, literally opened an account, made like 10 grand in 2 months and said, you know what, just take it out. Just take out the 10 grand and we're going to go on a nice vacation and I'll start over again. That's fine. And it has a drawdown. That's fine. My risk tolerance is fine. But we didn't change their retirement assets. Okay, that's the kind of things you can do when you're working with a portfolio manager that is trading. All right, this is what I do on my own accounts. So this is Spec Op. Oh gosh, At the peak of that blue line, we were actually ahead of the S&P by about 18% on the year. And then stuff happens. So cocoa futures, all right? I like to think of myself as, pretty conservative investor, and I thought I knew where the high was. So I got in down here at the bottom, and you see where it says sell stop? That's where I got out. I wasn't going to wait for it to trade to the bottom of the blue line because I'm a genius, and I know the market can't go any higher. And as you can see from this chart, I was colossally wrong. That's about an $18,000 error because I just didn't believe the trend could go any higher. So those of you in Spec Op, and it's a tiny handful, I've made my phone calls, you get it. On the right-hand side, Samasiki Holdings. This had an open position profit of $28,000. And then one day, the market didn't open. You see these gaps in the chart? And that is because there were no bidders. No one was willing to buy, and there was nothing but sellers. And so my nice $28,000 profit turned into a measly $10,500. Now, I get it. The risk on that trade was about $1,200, so that's almost a 10-bagger. But a 28-bagger sounds better than a 10-bagger. Why am I going through all of this? And you'll get to see why in the question and answer, because people say, why is it you're doing what you're doing? Why don't you just use package programs, etc.? Because that's what everybody else does. And because I'm a trader. And that's a D, not a T, okay? A trader. And we're bringing value to you. We are. And this is what I talk about. I mean, I know other managers talk about different things. I got something in the mail. I got to read this here. I got three things so far this year. Raymond James. We have Valentine's ideas for you. Click here to read the best Valentine's surprises. All our clients, we want you to do this. I got this from Schwab. March Madness. Okay. Pick your choices, and our top three winners will get a $30 gift certificate or something like that. Okay. Edward Jones, and this is looking ahead. So we have an Easter egg story. Click here and you can read this story to your kids. Thank you for being a client of Edward Jones. I'm sorry, but that's just not the way I run my business. This is the stuff we talk about because it affects you and your portfolios. All right. It just does. Okay. So I told you I was going to talk about drawdowns. So let's just look very basically. If you invest $1,000 in 1993 and you use just a very basic moving average, the system is a different issue we can talk about, but this is what it looks like. On the right-hand side, this is the related drawdown. Okay, so a drawdown is any time you're not at new highs, which is most of the time. You can't always be at lifetime highs, right? Most of the time you're going to be on a drawdown. So this hit 53%. Maybe 55% in 2009. Most people are not going to be happy with that. Most people aren't going to be able, they're going to pull their money. We didn't have that happen in 2009 because we got out early. That's a story for a different time. But that's what happens with buy and hold, because buy and hold, and I'm going to say this on camera, I've done it many times, buy and hold is buy and hope. Okay? And we're not willing to do that with our clients' retirement assets. GI and CG. That does not apply to DS. This does not apply to SO, Spec Op. Okay? So here's a simple 200-day moving average timing model. When the market goes down so far, you get out. So you see the flat lines here? That's when we're out of the market. And this isn't something I'm trading, this particular program, but it's similar to this. All right, you can see that. Let's go back. The maximum profit here was about $18,400. The maximum profit here, about $12,000, and on its way back there. But the drawdown was only 23%. Okay? Now, yeah, and thank you, Alice, for the disclaimer. I don't know why I got these mailings. We're not clients. I have no accounts with anybody other than Interactive Brokers. Nobody trades my money but me, for the record. All right, so back to our chart. The reason that we do this is because it's just too risky to have another 2008, 2009. Now, if you're 32 years old, you don't care. Maybe even if you're 48 years old, you don't care. If you're 53, you might start to care. If you're 68, you definitely care. And yet, there's probably a part of you that says, I just want to put it with those magnificent 7. And DS is Mag 7 in different weighting. So I do change the weighting. So Tesla is lighter weight right now than Meta, okay, or NVIDIA. And I have selected AI stocks in there, which have just been killing it, really. Thank you, Matt, for all our help on the research, too. We're going to get into more of that next month, okay? But that's why we do what we do. So back to this. Trading and investing can only be understood backwards, but buying and selling must be lived forwards. It's very easy to say you can handle a 50% drawdown if you're guaranteed a result. But who is guaranteed that? In fact, it can be pretty easy to lose faith, which leads to bad emotions, bad decisions, angry calls to your money manager. And I never want to have to face a client and say, we just don't have money management strategies. We just don't know where we're going to get out. We use our intuition. And the client will say, well, you're just intuiting that everything's going to work out. We're not going to have that conversation. Not with CG and GI. When people had that drawdown in 2022, of course, they were pretty far ahead. You can see on the chart. That's how we got the 290% return, because they made it all back when it came back. But they understood it was a speculative account, much like Spec Op is. So you can only do what you can handle, and we help you with that. We will not let a single client trade more aggressively than we think is in their best interest. We will not. We'll let them trade less aggressively if they sign off on it, but not more aggressively. All right. So say what you want. That buy and hold does make more money, but I would reply, well, it made more money, but it may not be the case in the future. Past performance is no guarantee of future performance. Matt was going to be with us this week. He's actually out on assignment doing research. So when we talk about a systematized approach, I do have that once we enter a trade. I buy at a certain level. I have a stop. I take the loss, I re-enter a new position, but that's called the bullpen. It's a discretionary process as to what assets are going into the programs, although the system itself, once we're in it, is not subjective. It's mechanical. But that's why it's been such a blessing to have Matt with me since November or so, I think, and I made the announcement last month. And so he should be on the show to interview with me on April's show. So your questions answered for the first time. See on the right-hand side, you guys should have seen this survey. And it's going to be a tiny bit long tonight. Maybe not. But so you're going to get it after this show as well. I think on Monday it goes out. So fill it out if you don't mind. And if you like everything the way it is, that's great. So I'm just going to read from this. So this was one of the best ones right here. So how is the government handling the dollar to Bitcoin? Well, the government wants to regulate Bitcoin, and they've already had the IRS clamp down on those who have accounts. This happened just years ago, but 8 years ago, there was nothing. I mean, there was no way to regulate this at all, but the government, because it's not in your best interest, it's in their best interest, and they're trying to regulate that. And they want to compete essentially with Bitcoin with their own digital currency. Every sovereign nation wants to do that, and it will fail. And this is all by the same person, by the way. And so what is China doing in the U.S. with their large purchases of farm and farm supply equipment, such as Smithfields? So Smithfield is the largest pork producer in America, but they also have grain fields, all right? And these are Chinese-owned companies. And it's not just Smithfields, which is the largest. I am not at all happy about the Chinese owning our farmlands. And I don't know how you stop it. I think there would have to be some legislation. I guarantee you, if Midwestern companies wanted to go into China and buy land there, they wouldn't get to do it. So without reciprocity, why are we allowing it? That's a political commentary, and we've got to figure that out. But the breadbasket of America being owned by our biggest enemy, bad, okay? And so, yeah, also purchasing property near military installations. This is an astute reader here, astute viewer. You're seeing it. You're definitely seeing it. If they get too close to Section 69 or whatever that is in Arizona, you'll see the uproars for sure. But I don't want them here. I don't want them in this country. We couldn't do it over there. I want reciprocity. If you're going to come here, we want to be able to go over there and buy. We want to be able to go and build factories and do whatever we want and not have you basically come in and say, we're going to shut this down and we're going to nationalize your building here and your company, and it's going to become part of the Chinese government. Not healthy at all. So one viewer said, more political. Well, I hope I got political tonight. And again, I'm not political for political sake, guys. I'm really not. I'm a registered independent. But I have to comment on things like budgets and deficits when it's hurting Americans. It's hurting Americans. It's hurting you as investors. So I got to call it out. Please talk more about how you choose your investments and split them into different categories and percentages. So I think I covered some of that tonight, but basically when a new holding enters any of our, well, not any, CG and GI, they're at a fixed rate of 3%. And that's because I'm risking only 1% drawdown. Sometimes it'll be 4%, depending on the price of the stock. But the goal is, like say on a $100,000 portfolio, if I buy ABC company, I'm only going to risk $1,000. So if that ABC company, however many shares I buy, trades to a 1% loss, it's gone. And the next stock goes in. That's why we have an active bullpen of ready stocks. But I don't buy a stock and let it take out 8% or 4% even of a portfolio's net worth. Not going to do that. I do not hold and hope. Intuition versus into wishing, right? The show is good as is. Thank you for saying that. I like Charlie. Well, thank you. I appreciate that. I always like to hear what you have to say about the banking industry. So, what I've seen about this? This is really interesting. So we're still digging out from Silicon Valley Bank from a year ago. So over a year ago, they collapsed, and I think the liquidity ratio rules are still catching up with that. The community, so New York Community Bank slashed their dividend to 1 cent. And you're seeing this with small banks around the country. So the thing is, people say, I want to be local. I want to buy local, my clothes, whatever. I don't want to always go to Walmart or wherever. I want to buy local. I want to bank local. And then the minute there's a credit swap, I want to bank with Morgan Stanley. All right. Or, Chase Bank or something huge, or at least U.S. Bank or Fifth Third, something that's a large regional. But that's what I'm seeing. And also I'm seeing that this fallout is still affecting the venture debt market. So there's a venture capital market, but there's also a venture debt market, and that has been affected. So banking sector, really interesting. We have finance holdings. Financial is obviously one of the 11 sectors. I would say it's number 4 behind technology, consumer discretionary, communication services, and then the 4th most aggressive would be the financial sector. The reason for this is because of interest rates. Obviously, the well-being of those stocks in the financial sector are tied to that. So that's all the questions I have, but I would strongly encourage you guys, when you get the survey, send me questions and I will read your question on the air the next time we are back, okay? And so there you go. That's the show. Those are the segments. Hope you found it interesting. We will be back in a month, and we always close with this. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 8 months from now, we're going to have a newly elected president. Between now and then, what do I have? 8 shows, right? Wow, I may have to do a show before the election, even if it's not the second Thursday, because it'd probably be the second Tuesday. We'll get that far when we get to November. I'm waiting to see if we've got any more questions here. Thank you. You're welcome. Guys, I never take for granted that you're here, and I know we've got new listeners tonight. We've got some LPL people that have come on and listening, checking us out. We are here for you. I trade because this is what I do. I'm going to be doing this for 10 years at least. In fact, I'm looking here. It seemed like I had one person who asked me to sort of elaborate on this. I wonder if I can find it. So what are the plans for LPL and me? So I've been providing 2 different RIAs, one that clears through LPL and one that clears through another company. My signals. So I don't actually manage those accounts per se, but I do. I send them the signals, they trade them. That relationship has been a good one. The timing or the contract for that has expired. I may keep doing that if they want to have me, and but I am seeing some LPL traffic that want to just come over because they like the mindset of our firm. I never will invite you guys to a golf outing because I don't play golf. I'll never invite you to a wine tasting because I don't drink. And I'll never show a picture of myself trick-or-treating when I was 8 years old because my mom had a bag over my head. Okay? We're here for the markets, and we presume that the data we're giving you is helpful. And if it's not, I'm giving you a platform to tell me what's important to you. Charlie Munger was in his office working 3 weeks before he died. He did an interview with CNBC 2.5 weeks before he died because he loved what he did. And I love what I do. And I plan to do this indefinitely, forever, for our own personal family assets. And if I'm going to do it for the family, then I'll do it for as many people that we can handle. We have a limited number. We're not just growing this company out like crazy because we have a personal touch. We're a concierge service. So sorry if I'm blathering on here, but these have been some of the questions. So those are the long-term plans, which are as long as we can do this. Every day I learn something in the market. I never thought that Japanese stock, 28 grand. I mean, we were planning on buying an ocean liner because there were just a few of us that had to be that long, because when we went to get out, there was nobody to take the other side of the trade. So every day the market teaches me, I learn more about risk control, and we bring you this knowledge in these monthly shows, but we bring it every single day when we trade your money. All right. I'll quit droning on. God bless you guys. Thank you for watching. Tell your friends. We will see you in April. What can I say about, have a great Easter. Don't eat too many Easter eggs, right? Kill your cholesterol. But enjoy spring. Puxatawny Phil was right. We're going to have an early spring. If there's anything I can ever do for you, shoot me an email, cb3@cb3.com. We will see you next month. God bless you all.